Latest edition of Real Talk, where we're going to talk everything with the great purveyor of his crystal ball and the economic forecast for 2024, Britt Fair.
Hello.
Yes.
Thank you for
Britt,
having me.
of course, but what is that thing on your head that we're starting the
Well,
show
that happens to be the maize and blue of the Michigan Wolverines, and I am a total bandwagon fan. But my son and I, he's a student up there, and we went to the championship game this past week, where I think they might have won the national championship, and they might have the previous week might have beaten somebody's Alabama Crimson Tide.
Okay, so I will forgive you on that. So yes, you beat Alabama, and then Mr. Nick Saban has also announced his retirement. So it's been a double blow in the last couple of weeks. So
yes, sorry.
Yeah, you know what? That's okay. So let's cheer me up. Let's talk about.
Oh, good. Let's talk about the economy.
Let's talk about the economy and see if we can cheer up our folks that are watching. There you go. So much better. All right, Britt, you know, it's you're no stranger to sharing the wonderful news that we've had over the last probably 18 months with the shifting in the economy and the real estate market. Now, it's funny if you actually go back and listen to what we talked about probably in the beginning of 2023. I think some of it was true. But you know, it's been an interesting ride, and now we go into 2024, and I think we're all waiting with bated breath to see, is there going to be a change? And you know, the good news is, obviously, in January, we've seen the lowest interest rates that I think we've seen since, you know, late spring of last year. So that's definitely a nice start to the year. And then we also have something else going on in 2024, and that might be a presidential election. So a lot of people are talking about that, what impact that is generally going to have on the economy. So let's start off with that. What are your thoughts on the upcoming presidential election and how that's going to bear for us on the real estate side?
Well, okay, I'll start back at least. I'll rewind a year and say I was totally wrong a year ago when, and so were a lot of people, I guess. But you know, I think the majority thought at that point in time was that the U.S. was headed for a recession, and you know, long story short, the U.S. did not have a recession. In fact, the U.S. Grew somewhat. Now, in housing, I would say we had a recession because people just didn't buy and sell as many houses. We were at I don't know if it's a 20-year low or 30-year low. It's somewhere, you know, but we were at about 3.8 million transactions-ish in the U.S. on home resales, which was, like I said, the lowest in 20-plus years.
Sure.
So we in housing had a recession, but the U.S. economy did not. You know, as we head into an election year, and it's not just presidential, obviously you have congressmen and senators and whatever. I have a theory, and you and I have discussed this multiple times, but you know, politicians are going to do whatever they possibly can to get reelected, right?
Yep.
And so, and that's nonpartisan. That's every partisan, every single person in office. It must be a sweet job because they all really want it. And so, you know, what's interesting about it is when I look at, you know, consumers, for example, like I have this working theory that consumers are exhausted. And I mean, partly tired, but like financially exhausted trying to keep up their spending. And consumers are traditionally about 2/3 of the U.S. economy as far as just people buying and selling, you know, and the rest is business and government or whatever.
Sure.
And what's interesting is I think that consumers are going to really have a hard time keeping up this level of spending. So normally I would say we are going to have a recession then in 24. If consumers are spending less, voila, you know, that means less spending in the economy. But I have sort of come to the realization that, and back to your government and election year, I think the spending by government is replacing, you know, sort of compensating for the fact that consumers can't keep spending. And you know, I went to a speech recently with the former Dallas Fed president, and his name, Robert Kaplan was his name. And he sort of enlightened me to this concept that, you know, a lot of these bills that were passed in 21, mostly sort of right after Biden took office, and, you know, again, wanted to do something, like, you know, and so they passed all these laws that had really cool names, like the Infrastructure Bill and the CHIPS Act, and the my favorite was the one that the Inflation Reduction Act, which really had nothing to do with inflation reduction as much as it had to do with green energy projects, right? So all three of those that I just named all have to do with giant investments in projects. And the interesting part, and this is what Kaplan was saying, was that most of that spending, almost all of that spending, hasn't happened yet. That, you know, we've been in the process of companies and states, you know, putting out these RFPs, you know, for who's going to bid. Hey, dog, stop. That who's going to bid for these things, and what are the projects that the government's going to fund, and which chip company is going to get the money, and, you know, so all this money has not been spent yet. And I think the federal government is going to basically be spending that money really in late 24 and in 25 and in 26. And so, you know, as I said, consumers are starting to get tired, but yes, the federal government is sort of taking the place. And so if the government spends more and consumers spend less, I think that it's possible we actually don't see a recession in 24, because the government is trying to spend its way, spend us out of having a recession this year. And again, both parties, it's pretty disgusting, really.
Yeah, no, absolutely. Britt, what's your dog's name? Since, I mean, we have to have a little.
That was Elvis.
Elvis.
Yes.
Okay, got it. Elvis. He likes to sing, so yes. Yeah, we're good.
Especially when we go on the air. That's, you know, he wanted attention.
That's okay. Well, and so let's translate that into what that really looks like, specifically for, you know, interest rates obviously have been the large, I think, push into shifting markets the last 18 months. So we're not going to go into a recession potentially. Therefore, what does that do with the potential decreasing of interest rates at a faster rate?
Well, so obviously over the last, I don't know, 2-3 months, we've seen rates come down 1.5 points, something like that. So, so that's been good. I'm talking mortgage rates and long-term treasuries. You know, I ignore what the Fed, you know, the Fed funds, you know, and the Fed is going to cut rates. That, you know, that doesn't really impact mortgage rates as much. We're really talking about the long-term end, and the long-term mortgage rates are really driven by inflation expectations, okay, and also by the appetite for bond investors to buy long-term bonds, whether that's U.S. Treasuries or mortgage-backed securities, okay. And so my theory is this: so consumers, I said earlier, I think are getting tired and getting tapped out, and we can talk about consumer debt levels, but consumer debt levels are problematic right now. And people are not going to be able to keep spending the way they have been.
Sure.
And so, as I said, the government is going to be jumping in and spending even more money, because, like I said, these bills, the Infrastructure and CHIPS and Inflation Reduction Act, the outflows will be occurring, you know, between 6 and 48 months from now. You know, I mean, we're talking, it hasn't happened, and it's not really imminent, but maybe later in the year. And so the interesting part of that is when the money goes out, well, obviously the federal government doesn't just have money sitting in a bank. Like they raise, they have to raise money from bond investors to then have the money to send out to these contractors who are building roads and bridges and green factories and windmills and whatever. And the issue is going to be so the issue in the long run, once they're raising all this money, is we're going to run out of people who want to buy bonds and who want to buy these long-term bonds from a government who has shown no signs of being able to manage their budget. And so what I'm expecting, therefore, is that in this next 6 months, that rates are going to continue to kind of fall downward, because consumers are getting tapped out, and all this government spending, additional government spending, hasn't kicked in yet. But when the government spending kicks in, they're going to have to raise their offering on these long-term bonds, let's call it 10-year treasuries, to attract enough bond investors to pay these trillions of dollars that need to go out for these government outlays. And so by raising the interest rate, and I'm not talking Fed funds rate, I'm saying enticing bondholders, treasury rates are going to have to go up to entice enough bond. There's a huge supply. That's it. It's a supply problem and not enough demand for those bonds. And so I foresee that in 25 and 26 that rates are going to be significantly higher. I know that's not what we want to hear, but I think rates are going to be higher on these 10-year treasury bonds to attract bondholders because there's a huge supply, and meanwhile China's not buying them anymore, and Japan's not buying them anymore, and Russia's not buying them anymore. So I think mortgage rates are going to have sort of a near-term low in 24, and then I think are going to have to bounce back up higher again once the government starts spending all this money on infrastructure and chips and windmills.
So exciting. And we always talk about this. You just bring so much energy and enthusiasm.
Yes. Well, gallows humor. You gotta laugh so you don't cry.
Well, but we also need to understand why it's going like this. Yeah. And that's the best way to educate our clients, not to sit there and say, oh my gosh, 2024 is the year to buy. Well, why? Why is it the year to buy? Not because rates have gone down. Why is 2024 versus potentially 2025? How do we hedge our bets? And I think, to kind of break it down in a layman sense, you're sitting there and saying we're going to see, and it's not an artificial dip, but it's not a long-term dip. We're going to see some relief on the interest rate side, probably through the meat of 2024, which in turn is still going to kick it out, because I think what's really interesting is we've talked about this as well. NAR came out with the top 10 suppressed housing markets that have the demand, but maybe, like you said, you've had just emotional buyer's fatigue, not even just out of the spending side. And 3 out of the top 10 markets in the country are in Texas. Yeah. So you've got DFW, Austin, and Houston are 3 out of the top 10 suppressed markets. And so when we turn around and we see, at least for our area, if I'm going to put my projection out there, it's going to see we're going to, dip back down. We've already seen some multiple offers kind of occur again and creeping back into certain markets. But I think we're at 6.5%, somewhere around there, 6.5 to 6.75. If we can get closer to 6%, I think that's when you're going to see the floodgates open again. And
5.99. I know it's no different from 6, but or it's only 1/100th. But anything with a 5 in front of it would trigger a mania of buyers and seller activity.
If you rewatch, I say rewind, that is also showing my age where you rewind a videotape. But if you rewatch our show from probably late last year or mid last year, I said the same thing. 5.99 from an emotional marketing standpoint was where I thought we would see that onslaught. And we did. We did see it open up again for a small amount of time. But we're not that far away. And I think that's the intriguing part, is what we can be doing is educating our sellers and our buyers that, hey, it's on the horizon. And if you're working with, sellers that are looking to sell within 2024, the best thing that you can do as far as some practical advice is get the home market ready now. You don't necessarily have to, put it on the market next week, but as you see those indicators and those rates starting to come back down and down and down, that's how the sellers can really capture this marketplace. And we don't know if it's going to be a 12 months, run on homes again, or if it's going to be 8 months. But I think, those of us that are working with sellers right now, encourage them to get their homes decluttered, start working on maybe some of the deferred maintenance or some cosmetic improvements, so that they can be ready to take advantage of that. And the same thing with the buyers. Getting pre-approved right now and understanding what your buying power is huge, because even at 6.5, we were at 8% at par. I mean, only a few months ago.
No, so it's crazy how fast it went up.
Yeah, but you know what? It's like gasoline when we went up to like $4 a gallon and we got back to like, like sub 3, we were all excited and ecstatic. It's just like
we've gotten used to these crazy high prices.
They abused us for so long. We're conditioned.
Yeah.
So let's talk a little bit of what's going on too in as far as the banks. We saw that. What was that last? Was that last March? That the
March?
Yeah,
March of 23.
Okay.
Yeah.
So what is that looking like for us with those banks that unfortunately saw some ill fate?
Yeah. Well, there were 3-ish big bank failures, and the interesting part of the bank failures, I mean, they were not your typical banks for the most part, but the interesting part of it was the biggest investment that those banks had were they were long-term treasury bonds.
Right.
Like they had loaded up on something that was deemed to be a very safe investment, right? I mean, the U.S. government, in theory, will never default on the U.S. Treasury bonds, and so I was a MBA in finance, and I mean, you're taught that is the definition of a risk-free asset.
Yep.
Is buying a U.S. Treasury bond, and so or the rate on the U.S. Treasury. Anyway, but what happened is that the banks got caught in something called duration risk, where they bought these long-term bonds, but then when rates, they bought them when the prevailing interest rate was something like 1 or 2%.
Sure.
Well, when the prevailing interest rate got up closer to 5%, well, the value of a bond was cut by a third, 40%, maybe 30 to 40%. And so these bonds were, if you had to mark them to market, were worth, let's call it 40% less than they had been when they were purchased.
Sure.
So if your biggest asset holding on your balance sheet as a bank has just lost 40% of its value, well, you're insolvent.
Yeah.
Right. And the publicity of that is very, I don't know, it's much more publicized than it used to be,
Sure.
Pre-internet and all that. And so all of a sudden rumors started swirling, and they were right that, such and such bank is insolvent, because they are, almost every bank was insolvent.
Sure.
The way that they, so there was a run on the weakest of the banks and the ones who had some weird profiles like Silicon Valley Bank. And anyway, so after 3 big bank failures, the Fed did something. They put in place a program that basically said, hey, look, for the time being, you will have the right, you banks, for 1 year will have the right to, if there's a run on your bank, or even if there's not a run on your bank, just know that you can give us your U.S. Treasury bonds, and we will give you the cash at face value, to where you will be able to, even if they're only worth 40% less, you can eventually pay us back the 40%, but we'll give you the cash now to cover that. So there shouldn't be any bank runs, and there haven't been any bank runs since then. So that's kind of a positive, except that expires in 2 months.
Awesome.
And so, or around April the 1st, I guess it's a nice April Fool's Day joke. So we will see that the Fed is saying we will not extend that. I'm guessing that they're going to extend the program, because otherwise we'll start doing the bank run thing again.
Sure.
But anyway, so that the bank solvency issue is one that was sort of temporarily solved, but basically just it was a bailout of the banks.
Yeah.
That we're not calling it a bailout of the banks, but that's what it was.
Sure.
And banks who didn't manage their duration risk properly are being bailed out, and we'll see if they get bailed out again come April Fool's Day.
Well, that's a fun thing to mark on your calendar, folks.
So the Fed is taking a big bath on that program. I mean, they're just losing money hand over fist. But that was the price that they're, and so all this is funded by taxpayers, sure. Right? Eventually, this is back to the national debt problem and how much we're going to have to raise in treasuries. This is all related to that same issue of, okay, well, there's a little, it's like the Dutch boy, right? With the hole in the dike, and he goes and sticks a finger in, and then he sees another leak, and he has to do, eventually we're going to run out of fingers.
Yeah.
And so, and toes. And so, I'm nervous about where we head, because we don't have politicians with spines who can get the budget in order, and they all want to spend and give tax breaks and all the things. And so right now, crisis was averted this past April, and we'll see if they renew the plan. But so for today, for the next 3 months, bank solvency isn't an issue. And then 3 months from now, it could be an issue again.
So let's bring some joy to our viewership for a minute, because you know what that.
Hey, the joy is you can get 5% just sitting in a money market account right now. So hey, I mean, if you're waiting to buy a house and you have a down payment, you can get 5%, 4 to 5% on your money market savings, and wait while you're finding the right home, and then you've got a down payment making a little bit of interest. So that's a bright spot.
Britt, did you just tell people to wait and put their money in a money market account at 5%?
No, have it in a money market while you're looking for a house. That's your down payment.
Okay, while you're looking for a house, do not park it there. Because what I was going to say is, the good thing that we can talk about is, with all that's going on and all of the concern, tangible assets are still your safest bet right now through this type of this type of marketplace, just across the financial board, right?
That's my take. Is 2024 is the year to buy a house, or to make sure that the house that you are in is one that you are going to want to live in, and want to live in for a while, ideally, because I do think that all this money printing that we're having to do, I mean, obviously the borrowing of the money, we're basically just sort of creating money out of thin air, right? And so that is all very inflationary, right? We're just creating more dollars. And so I think that causes inflation, which will cause, your rent will continue to go up dramatically every year if you're a renter. And, to me, I would rather lock in a mortgage rate and a mortgage payment because I believe that fixed assets like houses or bars of gold or barrels of oil or, wheat fields or whatever are some of the few things that actually are a nice hedge against that inflation. That doesn't really offset entirely the inflation, but I would much rather be an owner of assets than a renter of assets at that point. And I think that's where we're headed, starting with that 2025 sort of resurgence of government spending.
So since I do not sell gold for a living, I'm going to focus on the hard asset, tangible asset of a
or start selling gold. Get your gold broker's license or whatever.
No. I don't think that's happening.
No, I think housing is it's going to be. I think it should be a big year for housing in 24, because I think it is a with rates having come down a little bit, and in my mind, I think rates are going to go up after that in the short, 25, 26. So to me, I think 24 is a great, if you can save up the money for the down payment and, qualify for the loan or whatever, like I think it's going to be a good time to buy, because like I said, I don't think you want to be a renter in a hyperinflation. And maybe that may be overstating things, but a high inflation market, well above the Fed's 2% inflation goal. I think we're going to be, 3, 4, 5% inflation, just because I think that's the way our spending is going, and on all this, trying to manage the federal budget.
Well, so I think we kind of let's break it down for a second, because obviously you also have the privilege of owning a title company with several locations, and being able to geek out from a data perspective and see what things are happening as far as volume goes. But for me, it's like, okay, you can have bad news all day long, but what are we doing? What are we doing to sit there and combat somebody's concern or friction to say, yeah, but interest rates are still high. Okay, you know what? That's a variable. The constant is the asset that you're purchasing. The variable is the interest rate. But you turn around and you talk about the same, variables are in place in the rental market, and we have more people in the rental market that actually qualify to buy, more so than we've ever seen. And I think that's also because we're seeing people that are in their 30s, not only because it is much more difficult and more unaffordable to buy that first home. Some have just gotten to the point where they're more comfortable with renting. But with that comes a really big price tag. We've talked about insurance. So we had Todd Campbell with Farmers on a couple of weeks ago, right? I know it's such a fun topic. But often it's funny when we talk to renters, they sit there and say, well, I rent because I don't want to have to pay taxes or insurance. And it's like, you are paying taxes and insurance. It's just baked into your rent. And so sometimes it's just having that qualifying conversation. But let's talk about insurance for a minute. And because that's another sexy conversation that we can really get everybody excited about. But, that's something that we talked about. And you kind of hadn't thought about people transacting real estate because the insurance market is bad.
But well, again, that I'm not really here to blame insurers. I think insurers have just gotten killed the last couple of years with, hailstorms and, obviously that's big here, and tornadoes and those kinds of things. And you got hurricanes and, but, I own a little commercial office building, that got hit by a hailstorm up in the Allen McKinney area. And, that came through, maybe it was March, April of last year. And every home, every building, is getting a new roof. And, the fellow owners and I, had these two buildings, and, we basically needed a whole new roof. Right. And I mean, it was just, that's all it was. It was a new roof, but so anyway, they quadrupled my insurance because we got the new roof, and so, and again, then I look at my house, which hasn't needed a new roof. I'm in Dallas. And the, my insurance doubled, and I didn't have a claim, didn't do anything. And so anyway, it's just, so when people are in those positions, if your budget is super tight, which, hey, this is America, that's just about everybody. I think that is potentially going to loosen up some of the inventory. Some of these people who are holding on to their house and saying, I just can't afford to keep doing this. If the insurance is this, I may need to downsize, or I may need to be a renter, or I may need to go get a different job or a second job, And so, I think that's one of the things that also may loosen up some of this inventory and allow for more transactions this year, is because, I mean, this insurance thing is just nuts. I mean, the shock on my face when I got these renewals, the better of the two was a doubling. Basically my insurance doubled. And the other one was 4x.
Well, and that's what we're dealing with. And so that's the whole thing. I mean, with unfortunate threats do come opportunities for some people. And so I think I discussed with you that, I'm seeing investors that want to sell some of their older homes in their investment portfolio, not because they're bad homes. In fact, they're probably performing really, really well, but instead they want to mitigate their risk. So let's sell some of their more affordable, older, homes in their inventory, which when they put them on the market, then it actually probably goes into a first-time home buyer kind of marketplace, where somebody's, scooping something up that's more affordable for them, but it's not performing as well on the investment side. So you're still seeing transactions happen. It's just for, different reasons. It's not as much as life circumstances. It's, those variable escrows that are starting to creep up and get people. So,
well, and then, go ahead.
No, you're fine.
I was going to say, one of the other topics that I know you have been asked about, and I hear about it all the time also, is, foreclosures, right? Is there a big foreclosure boom or coming or whatever, which I do not foresee a big one of those, just with as much equity as most people have in their houses. If you've been in for more than a year or two, you probably have some pretty good equity in your house because home prices rose so much. So I don't really see foreclosures being a problem, but, I do see that, as I do think that the general economy is slowing down a little bit, until the government funding starts kicking in. So I do think we'll probably see, unemployment come up just a little bit during 2024. And so unemployment and illness are probably the top two reasons why people are forced to sell their house. I'll call it forced sales rather than foreclosures, because if you can't afford to make the payments, you may be threatened with foreclosure, but you could always, if you have enough equity, turn around and sell your house. So that's another reason that I think that some of this inventory could get loosened up in 2024. Is I do foresee that the business climate slowing down somewhat until the Fed comes to the rescue with all their spending, and the federal government, both fiscal and monetary extensions, I guess. So I think that's another reason to see that, hey, and again, I don't mean to gloat about any increase in unemployment. That's not a happy thing, but it is when you talk about housing and the limited supply that we have had. I think that's another thing that we're going to see more of, is more of these people who need to sell because they lost their job. Obviously, illness, I assume we'll probably have the same number of illnesses as last year and whatever, but as far as job losses, I actually think we're going to see more of those in 24 than we saw in the last couple of years. So again, that's not to celebrate that, other than to say that bringing up forced sellers on insurance, I think we're going to see forced sellers on more job losses as well. So again, not to that sounds awful. It sounds like I'm celebrating that, and I'm not, other than I just, that's what I expect to happen.
It's the reality of it. And I think those are things that we just need to have kind of in the forefront of when we're dealing with potential, sellers at this time. And we talked about this the last time, and I know Altos research had come out last year and said 42% of homeowners do not currently have a mortgage. And I think that's really, honestly, the biggest statistic out of everything. If anybody retained, and of course that can change year over year, but for 2023, Altos Research, which is a great group, by the way, 42% of homeowners have no mortgage. So if you don't have a mortgage, if you are getting into that imbalance of maybe you've lost your job, or your job wages have gone down, your hours, or the variables of taxes and insurance make it, to where you can no longer do that, or you just simply want to cash in on that equity and do something else. I mean, we are seeing people that are saying, you know what, I do want a more simplistic life, so I'm going to cash in. I don't have a mortgage on my home, and I am going to go rent, or I'm going to go travel. But with nearly half of America not having a mortgage on their home, I think that really puts us in a different leverage position than it did in the market crash in 2007 and 2008. And I think we have to continue to educate realtors and it's not ignorance, it's just understand that the conditions that we were in then are not the same conditions that we are in now.
Yeah. And I haven't seen the details of that study, but I would imagine that the majority of those people who do not have a mortgage are probably older.
Sure.
Right. I mean, at least some of them have been in their house for 30 years, right? And paid off a 30-year mortgage, or, it's not everybody, but that's just my, imagination. So I do think we're also going to see, this isn't necessarily a 2024 thing. It probably is happening in 24,
sure.
But this boomer transition, right? I mean, and I don't mean boomer in the terms that my teenagers call anybody over the age of 40 a boomer. Yeah. But I mean, literally the baby boomers, who, probably own a lot of the real estate and own a lot of the real estate free and clear. But, I do think that's also a group that, is probably going to be in the process of starting this home selling, as they reach retirement age. I think the oldest boomers are getting close to 80 now. Obviously there are people older than 80 who still own houses as well. But anyway, that's just a large cohort, when you talk about the population growth or whatever. And so as that group ages out of the typical home ownership, and maybe want less responsibility or want less space than they had before or whatever, I also think that's this, sort of a positive for the future of supply. And it's starting to happen now, and, in 24, and it's going to get bigger each year for the next few years as those boomers start to want to downsize or unfortunately pass away from just reaching older ages.
Well, I think when I was doing my research just a few months ago, I think boomers had outpaced millennials for the first time as like the largest demographic transacting real estate. So it was kind of interesting. So I do think we're at a volume base that we haven't seen there before. And, so It is. It's really. I mean, it's neat. We can nerd out, and you can at any point between NAR, Altos Research, Real Trends, Housing Wire. We've got RPR, which is a great free resource that realtors can use to see, data analytics and different things in our area. But, the biggest thing, if we're just talking about hyper local, and that's what, our viewers really want to probably look at, is the fact that we are still in one of the strongest economies. Sherry Fearbrocker just popped in. She said, "Hey, Grizzly Adams, lots of info here, some negative, some positive. Truly seems like a cycle we've lived for most of our lives." What do you say to Sherry?
Well, first of all, hello, Sherry. I feel like any Seinfeld fans know hello, Newman.
Yes.
But no, it's a mixed bag. I'd love to say, I mean, again, it's always a mixed bag, though. When you go back to where we were in 2020, the second half of 2020, when things were going like gangbusters, right? It seemed, some people say, oh my gosh, that was the best time ever or whatever. Well, was it that great if you were a home buyer or a buyer's agent who you had to go show 100 houses to people and before you could even possibly win a bidding war?
Sure.
I mean, it was not the best time. It was pretty good if you were a listing agent or a home seller. So, I'm sort of looking at it the other way, that this is now, I'm seeing some opportunity for buyers that we haven't really seen over the last 3 years or so, that, I think rates are coming down a little bit. And I think it's going to be something that you want to own. And so, I'm very pro housing because I think it's going to be, I mean, A, it's what I do for a living, but B, I really do think it's a hedge against the unfortunate federal debt issues that I see in our future. And I mean, the U.S.'s future, but also other countries. I mean, most other Western nations are having these same debt conversations because it's scary in a way. I mean, we haven't reached these numbers before.
Well, and I think here's the biggest thing is that people are having to make adjustments in their lifestyle to purchase a home. And I think that's the hard part, is that there are people that just aren't willing to make those lifestyle adjustments. They still want to go out to eat. They still want to Uber Eats and DoorDash, and they still want to, go on vacations, and they want to do all these other things. And ultimately, you can't have your cake and eat it too. If you want to own the largest asset that you're ever going to own, you might have to tighten the belt in certain other circumstances. Because when you're really looking at the comparison chart, let's just use a $500,000 home. Yes, it is still a lot from where it was 2 years ago if you bought a $500,000 home in 2024 versus 2022. But you're talking about, depending on how much money you're putting down and everything else, it could be $1,000, right? And we've talked about it before. And I really try to use that for people to kind of mentally understand this big puzzle that they're doing. So if you're spending right now with increased interest rates and insurance, $1,000 more a month, that's $12,000 in 1 year. I know people that take vacations that cost that much over a 5-day period. Sometimes it's just speaking the language. And I'm not saying don't take vacations, live your best life. But at the same time, it's not ever going to get cheaper to be a homeowner, specifically in North Texas, unless something catastrophically changes. We have one of the strongest economies in the world. And I think that's what people need to understand, is that Texas as its own I think is number 8 as far as the ranking of GDP in the world. It's against other countries and nations.
Well, no, it's, and again, you're going to have to pay to live somewhere.
Yeah.
I mean, to whether it's rent a house, whether it's rent an apartment, whether it's buy a house. And so again, renting has its place, and it will always have its place. And especially if you don't know where you want to be, or you don't know what you're single now, but maybe you want to get married in the future, or maybe you want to have kids or whatever. So obviously renting can be a really good strategy. But like I said, I do think that owning a home, if we do have the inflation that I expect to see, like you don't want to be at the whims of inflation if you don't have to be. If you're kind of on the fence of owning the asset, owning the house as a place to live rather than renting the house as a place to live. I think this is one where you want to back to what you said about, maybe skimp on the vacation and maybe skimp on the eating out every night, and but save for that down payment. And because I do think 24 is going to be a near-term opportunity for home buying.
Yeah, absolutely. And here's a great example. So I had a really nice young woman who had a great job. She wanted to buy a house and wanted some land, had that opportunity. And so she did. I mean, she bought kind of her little dream compound, 8 acres, and it was great. And her dog were living her best life. And I get a text message the other day, and it's, oh my gosh, I got married last year, just had my first baby, and we've moved to Oklahoma, with my company, have relocated. And I'm devastated that I have to sell my dream home, but life has changed, and it's, what an amazing life that is, right? And so it's a happy life circumstance that is doing that. And she even said, I'm sick because she got a great interest rate, and it was right before things started to tick up. But I told her, I said, look, but if you had never bought that house, I mean, she's going to make $100,000. And that an amazing investment she did. She had a great 2 years, and now is in this wonderful season of life. And so she got to enjoy where she was living and make $100,000 that will help, provide and propel her into this next cycle of life. And so that's what I tell people. You can't demonize other people that have decided to pull the trigger, but people do. And it's like, oh, it must have been great where you bought 5 years ago. Well, it's always a good time to buy. That doesn't mean you can. It just means I can always argue why it's a good time to purchase a fixed asset in real estate. You just have to figure out whether you have the stomach to do it.
There's the old saying, and I'm going to get it wrong, but it's something along the lines of the best time to have bought a house was, a few years ago in the past. And the second best time to buy a house is today.
Now.
Meaning get it done now. And again, for some people buying a house, you don't know your job situation, or you don't know your family situation, so I totally get that. But the point being that it has been a pretty good investment, but I don't really necessarily mean like buying a bunch of houses as instead of stocks and bonds and gold, but I mean it in terms of avoidance of rent and locking in your payment. And yes, it has turned out to be a great capital markets, capital investment, earning that 100,000 that you just described. But, even just living and avoiding rent escalations, to me is something that is very attractive about buying a house.
Well, and I was trying to find the article really quickly, but somebody had shared it and was just basically talking about the financial market, that for the first time, DFW is actually one of the most attractive markets for the major financial companies behind New York and Chicago and California. And so you're talking about these companies are saying, and they cited that it was cheaper wages and more affordable housing for their employees. So you've got these major financial corporations.
Relative to New York, anyway.
Well, I mean, that's the whole thing is, you have to look at through the different lenses. For native Texans, yes, they want to puke. But for the rest of the country, they sit there and you go, oh, wait a second, you can still buy a really nice house in a great area with great schools, thriving economy, retail, everything that you want at your fingertips for $500,000 or $600,000. They'll take it all day long. And I think that's why we as realtors and people in the industry have to educate them on the narrative. It doesn't mean you have to be happy that you're spending $500,000 on a house you probably could have bought for $350 4 years ago. But at the same time, it's not going backwards.
I don't, we may have some minor softness, and, like if you look at Austin, I think Austin is one of the spots in the nation that has had price decline, the largest price declines. Now they had huge run-ups also before that, but I think their prices are down about 15% from the highs. And that's one of the highest declines in the nation.
But now they just charted it as one of the most suppressed markets in the nation.
That's what I'm saying. Okay, so you're down 15% from the high, but are we saying that we don't think that it's ever going to get back to that high? I think it eventually is going to, and
Absolutely.
So, again, that's why I say find a house that you want to live in for a while. And, and again, I don't know what for a while is, but 5 years, 10 years, whatever it is, and sit back, and you don't get, that's 5 or 10 years of rent escalations you're avoiding, and you're paying off a little bit of principal each month, and you may get some price appreciation. You probably will.
Yeah.
Again, I'm such a cheerleader for what we have going on in DFW, both housing wise, but also, there's just, as you said, all these, Goldman Sachs moving their regional headquarters with 5,000 people to the right over by Victory Park, and just like that I think it's just pretty amazing what's going on. So
well, and I think they called, the up in Grayson County and Sherman is, it's little Silicon Valley. That's what they're really dubbing that area that it's going to grow into. And I think that's where we just have to understand that while it's, I think what we like to do is get emotional and romanticize how things were 5 years ago, 10 years ago. And ultimately we're just not there anymore. We were talking about, just from the MetroTech side, a month is equivalent to what a year was not too long ago, as far as, as far as change and growth and everything else. And I think that's the hard part, is really educating consumers to act faster. And I think that's probably the most difficult thing that we've seen, since 2020, is that consumers are just having to act faster than they're comfortable with. And that's why the more education that we can be armed with, and the more information and statistics to sit there and say, I know this makes you sick. I know the thought process that you're going to be spending $800 to $1,000 more than you were a couple of years ago. Don't look at that. That wasn't an opportunity. That's not where you are. Yeah. But ultimately, we still have to prepare for the future. And it's just pulling that initial trigger. That's the hardest part, because I can tell you, it's still, Britt, everybody that I've helped procure a property since, probably mid, to late 2020, there's only been one circumstance where, it didn't end well. And that's because the relationship didn't last.
Yeah.
Everybody else is still ecstatic that they went and they put themselves in that position, because ultimately they still want out, and they're making memories, and they're creating appreciation. And those are the things that I think we need to continue to harp on, not these artificial conversations with, you can always refinance. Well, how about those people that were sitting there and saying that a year ago?
Yeah.
That don't worry, you're going to be
now rates are higher than they were a year ago. And yeah, exactly. Now, I think, we have two big things going for us, and again, this isn't necessarily intended to be a cheerleader for home ownership, but in Dallas Fort Worth, we got two things, the general inflation that I expect, and that we have seen general U.S. inflation, general prices are up about 20% over the last 3 years, cumulatively, just, on average, about groceries and homes and cars and everything else. So general inflation, I don't expect to go down. I expect, as I said earlier, I expect general inflation to actually be higher. But then you go, okay, is Dallas Fort Worth expected to become, or to continue to become, relatively more popular, or do you think it's going to become less popular as a place, in the U.S.? And I don't think there's any doubt that more people are going to be moving here than away from here. That's just, for all the Chamber of Commerce reasons about no state income tax and center of the country and decent weather, in the wintertime, and bearable if you have air conditioning in the summertime, those kinds of things. So I think that we're going to, like what you said about the New Yorkers moving here, and, they think it's cheap. And so, we're going to continue to grow here. So you have that type of inflation too, from more people wanting to move here than move away from here. And so when you get that double impact, that's when you have the sort of those positive impacts of home ownership, and those gains that you get from owning a piece of dirt, an asset, a home, rather than renting it.
Texas is, I think, 2 years in a row, the number one net migration state now.
Yeah.
We surpassed Florida. And that's,
it's always funny, the U-Haul or whoever it is, when oftentimes has that study, and it's so fascinating, because they're having to pay people to drive U-Hauls to California, because they're all one way. They all collect here in the various places here in North Texas and Austin and Houston and wherever. And they say, we need to get them back to New York and back to California. So they actually
more people want to leave.
Yeah.
Yeah. No, and I think that's the point is we just have to get to the reality. And once you can just swallow that big pill and go, okay, this is what it's at. We have to recalibrate what we want. And here's the other thing too, Britt. I talked about having your cake and eat it too. What I've had to do with some of my younger home buyers, first time home buyers, pragmatic consumers, is just had to say, you're not going to be able to live in Dallas proper. You're not going to be able to live in Frisco proper necessarily. And that's okay. That you can one day, but you're going to have to invest in real estate and garner some equity so you can level up just like so many other people have. But we have these amazing areas that are bustling up the 75 corridor up north. You've got Van Alstyne, you've got Anna, Melissa, those are still really affordable as far as you're talking about like a first time home buyer,
Absolutely.
area, and that's
but even
think
about it, 25 years ago, let's say, maybe 20, but definitely 25. I mean, you could say this exact same thing about Frisco. And Allen and McKinney.
Yes.
And,
yes.
they were those places where you go, hey, you can get a starter home. And then, once you make it, you could move to Plano or, and now here we are. And like, the people who did that, I mean, they may, who knows what their house was, but like, shoot, the dirt is so valuable now. I mean, just even if they put a tent on the dirt, like, and they've made a ton of money,
Don't get anybody any ideas. We're still having to battle municipalities on accessory dwellings, and tents are still considered. No, I'm just kidding. But no, I mean, that's a great example. Is I think a lot of people are wanting that instant gratification on. I want to live that magazine quality lifestyle or that Instagram quality lifestyle. And I think what we can do, for our clients is just to say you got to get in the game, and let's figure out the best way to get you in the game. And if that's a condo, if that's a townhome, if that's, I call it, suburban rural, it's one of these ancillary areas like Princeton, or Josephine, or going up to Van Alstyne or something like that, where you might consider it still a little bit of a rural area, but it's becoming a suburban metropolitan area in its own right. And so where you have the developers that are willing to go and sink the money, that's just going to continue to grow. And so we've got a few minutes left. And I think what we can do is maybe talk about what we can do to kind of position ourselves in 2024. So first thing, I've talked to you, and this wasn't a pat on the back, but 2023 was really, really rough, but it was still my second best year in real estate. But a big portion of that was the fact that I recognized that the traditional metrics and forecasting of real estate was changing. And I started diversifying in the type of real estate I was transacting. I made sure I was proficient and educated before that was something I could be able to do. But I've over the last probably 4 years continued to kind of diversify into different niches. We do a considerable amount of investment properties. We do property management now because we saw a void in that space for our investors. And so, for us, it's like we might not be making, a mint in one direct area, but because we have multiple streams of revenue sources, it's really been wonderful for, my family and my company. And I've been saying that for quite some time, is that I don't want realtors to practice out of their professional competency or comfort zone, but it's okay to go back to the drawing board and learn. And now is a fantastic time before things start heating up is to, go and educate yourself. I'm going to do a shameless plug for Metrotex here because, we're here through this platform because we find that it serves, a very vast community that might not be able to go in person and do education all the time. But we have, we're looking at bringing residential to commercial classes, introduction to commercial, hey, we got Amy Hansen who was on here earlier. Do you want to be a property manager? She offers great property management classes. Sometimes I think it's just to scare people away from doing it, and they should be scared. But it's education, right? Yeah. And we've got just different things. We've got, farm and ranch classes, different stuff like that. And so what I would tell people right now is if you're struggling with trying to figure out how to kind of penetrate these different cycles of real estate is go back to the basics and educate yourself. And right now is a great opportunity. And Britt, you've got a thriving title business. And I know you guys are also a wonderful resource to offer educational opportunities, to your realtor partners.
No, we're doing a lot of that. And, especially, well, I mean, we're doing that all the time, but it's interesting. The other thing related to this is some of it's just a mindset too.
Yes.
And what I mean by that is like 2023, I'll just speak in the title business, but I mean, most realtors probably would feel this way, but like it kind of, I mean, it felt remarkably slow for me. And I think for most of North Texas realtors as well. But I think a lot of that has to do with the pace that we were on in 2022, 2021, and second half of 2020, I mean, and I always use the analogy of, if you're driving 100 miles an hour and then you slow down to 55, it feels like you're crawling. And meanwhile, 55 is the speed limit in a lot, on certain highways or whatever. So I think that's the other thing is just sort of get out of that malaise of, oh, woe is me. 23 was not as good as 22 and 21 and 20. And, it's like, okay, well, if it wasn't, that doesn't mean it was awful and you have things to build upon. And, so I guess I and everybody else have to stop feeling sorry for ourselves and get out there and make it happen, because I think, there's still, as we talked about, there's just so much opportunity in North Texas, and, there is market share to gain, and there is growth. So that even the market itself is growing. So I think 24, like I said, the pie will be growing in 24 versus 23, and somebody's going to get that gain in market share. So why not be us?
Well, here's what I will tell you. What I did do is I just invested in. Okay, now
Stanley.
I had these already. Okay, so for and I know it wasn't these Stanleys that were necessarily the run on the market like the 2021 real estate market was. But I mean, gosh, that's nuts. But but you know what it goes down to? I know, my mother. Good grief. But here's what it is. It's just like you said, it's a mentality. I mean, you told people that, these were a commodity that were in limited supply, and people said, I got to have it.
Yeah.
And I think if we redirect the narrative for 2024, and let's not go back to a dynamite up our rear ends running around like that this year. But I think if we go back and we really talk about the strength in our economy, what's going on, we're the number one net migration state, the businesses that are coming here, the opportunities for appreciation. And we really talk about, I get it, it's more unaffordable than it was 5 years ago, but I got to tell you, it's still worth the investment now. And I think we need to be having that conversation. And I've had some people pop in here that are great vendor partners, talking about different things. And Britt, I've told you the same thing. Now is the time to also align yourself with those proper, affiliated businesses, so we can all be speaking, the same narrative, whether it's a title company or a lender or whomever else, that it's still a really good time to buy real estate if you can physically afford to do so. We just have to be talking about it with the right perspective, in hand. So,
and you can't have your eye set on, as you said, living right there in the heart of Frisco and, at the Star or whatever. Like you need to understand that, you don't always start at the top, and you may be having to drive a little bit further to get to the Star than living right next door. But, hey, that's the next hot market is whatever, Salina or, Gunter or what, whatever it is, or whatever direction you're going to head. There are a lot of great places to live in North Texas, and that's where the growth is. It's on the edge. And so you will be in the growth path versus, if somebody buys in Plano, not, I like Plano, but like there's no growth in Plano. Plano is fully grown. Right.
Yeah.
There may be price growth, but like you're not
You're
going to
landlocked
from being in the growth path like you are in if you're in Gunter or in Princeton or these places that you mentioned earlier.
So what's the movie and the old adage? If you build it, they will come.
Field of Dreams.
Yes, Field of Dreams, and man, Kevin Costner is probably like one of my first crushes.
Yeah.
But I think that's the biggest thing is that again we have to kind of go on a sense of gut and faith sometimes and say this might not be exactly what I want today, but could it be what I want 5 years from now? And could I see exponential growth? Hey, and Sandra said south of Dallas. I mean, gosh, it's all over outside of the nucleus of what is the heart of Dallas.
Yeah.
Just go north to Grayson County. You can go west into certain areas of Tarrant County and Johnson County. You've got
I've been
south
spending
into
time down in Navarro County, and there's plenty, in Ellis and Johnson. I mean, like even southern Dallas County. I mean, there is lots of growth potential, a lot of different directions. So it's not just just McKinney, northern McKinney that has the, whatever. I mean, it's everywhere.
No, part of it, Sandra, you're absolutely right. I just happen to live in this corridor. So it's one that I, obviously reference, but that's the whole point is that there's growth and development. And it's a matter of recalibrating what your goals are. And if you need to strategically have a lifestyle where it is close to your work or to family or something else, then understand that you're going to pay a premium. But if you're looking to still get into the marketplace, find an opportunity to get in and buy your first property. There are still amazing areas of growth and opportunity here in the North Texas area. So, Britt, we're a minute over, but I want to give you an opportunity. What do you want to leave our viewers with other than something to go sob in a pillowcase with just a little bit later? Yes.
Well, when life deals you lemons, make lemonade. So I think 2024, look for the house to buy that you're going to want to be in for a while. And, like I said, I think it's going to be a really good opportunity in 20. I don't mean prices are being rolled back to 10 years ago prices, but what I mean is I don't think you're going to be disappointed if you're owning a house that, 5 years from now that you bought in 2024. I think you're going, you can probably say that about any time frame in the history of Dallas, but I feel like that's the good news is I think that there is going to be a lot more action in 24, and a lot more transactions. And I think that it will be a really good time to buy and especially if you want to hold.
So the other thing I'm going to plug is to guys, go on mymetrotex.com and check out the upcoming events that we have over the next few months. Because if you're sitting there and don't know what direction to go and you get frustrated, the best thing that I can tell you is get in the rooms with other people that are in the same spot as you and educate yourself. And of course, we've got it right there, mymetrotex.com/events. We had a great one that was the, Trek and Texas Realtors legal update today, which was also a great one. We had 150 people at the association listening to that. We've got an amazing, Metrotex leasing and property management and NARPM event on January 24th. That is going to be absolutely amazing. And if you really are thinking about maybe getting into the leasing or property management space, you will not be disappointed. But that's the biggest thing. Don't put yourself on an island. Educate yourself, surround yourself with other people that can bring you along and help you weather the storm and make 2024 absolutely a banner year for you guys. And the last thing I'm going to say, Britt, you said when you have life gives you lemons, make lemonade. And my rebuttal to that is, and then put vodka in it.
It is happy hour. It's 6:30 somewhere.
Well, I appreciate it. And thank you, Ruben, for tuning in and so much of our other viewers. We are here. Share this with your friends. And of course, reach out to myself or Britt Fair if you have anything additional that you would love to ask. And Britt, let's look at an amazing 2024. And okay, we're going to be doing. Yeah, we're going to do this. We're going to do this again in about 6 months from now, and let's see which ones were right. Okay.
Yeah. Okay. It's a deal.
All right. And congratulations on Michigan.
Hey, go Blue.
There you go. Go Blue. All right, guys. Have a good evening, and we'll see you.